Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 15th, 2025. I am Luna.
I am JPMorgan. We're looking at, well, a really interesting situation in the markets. On the surface, things look pretty good. U.S. stocks, NASDAQ hitting fresh highs, Bitcoin's on a tear, even briefly past $122,000. But underneath all that, there are some major economic and political undercurrents swirling. Feels like potential turbulence ahead. So today, our mission is to unpack the Daily Market Overview, July 15th, 2025. We're going to dig into the key trends, the macro events shaping things, really help you understand what matters most. Okay, let's get into it.
Yeah, exactly. And what's fascinating, I think, is how you see these daily moves reflecting deeper worries. You mentioned gold and oil, they spiked, then reversed. And the 10-year Treasury yield, it climbed to 4.44%, almost a one-month high. That yield number, it feeds into everything, mortgages, business loans. So seeing it climb suggests, well, anxiety about inflation and maybe supply issues.
Right. And looking closer at the market action today, you really see that paradox. The main indices edged up slightly, but sector leadership was all over the place. Look at big tech. Tesla jumps 1%, but Apple falls 1%. What's driving that kind of split when the overall market seems okay?
It really points to a selective market, doesn't it? Investors are definitely picking and choosing. You see these hot theme stocks like Palantir surging 5% to a record that's driven by its own story, but then a big chip maker like Micron sank almost 5%. Seems like worries about softer demand there. So yeah, the rising tide isn't lifting all boats equally. Individual company stories, maybe narratives, seem much more important right now.
Okay, but moving beyond just the numbers, we had some significant political news over the weekend. President Trump threatened the sweeping 30% tariffs on all imports from the EU of Mexico, effective August 17th. But here's the thing, the market reaction was surprisingly, well, muted. Analysts are saying the shock value is gone. What does that tell us? Are markets just numb to this now?
That's a really key question. The quiet reaction could mean a few things. Maybe markets are desensitized, like you said. We've seen these threats before. Or maybe they just don't think it'll actually happen, or not to the full extent. But it also suggests, I think, this growing disconnect between market mood and traditional macro stuff. And adding to that policy confusion, Trump also turned up the heat on the Fed publicly, demanding rate cuts down to 1% or even lower.
Wow, 1%. But the Fed seems cautious, right? Still worried about inflation.
Exactly. Fed officials are signaling caution. Inflation's still elevated. And if you look at the futures markets where investors bet on rates, they're only pricing in about 0.5% of cuts by the end of the year. So this political pressure, it really adds a big wild card for interest rates.
Policy uncertainty, Fed pressure. And then there's the fiscal side, too. The Treasury Department confirmed plans for, well, a staggering amount of new debt, over $1 trillion in T-bills over the next 18 months. That's short-term debt aimed at funding the deficit.
Yeah, $1 trillion plus. It's a huge number. Now, what's interesting is that on one hand, money market funds have record amounts of cash, so theoretically there's demand there to absorb this supply. But still, that level of unprecedented borrowing, especially combined with potential tariff fallout, it could definitely put upward pressure on interest rates, and that means higher borrowing costs for everyone, companies, consumers, you name it.
So, okay, let's pull this together. We've got high stock prices, Bitcoin soaring, but also tariff threats, Fed pressure, massive debt issuance. What does this all mean for you, the investor listening? The report we're looking at mentions Q2 earnings coming up and key data like the June inflation report. Are those the next big tests?
I think so. Those are definitely key catalysts to watch. The core thing here is, look, the U.S. economy itself seems relatively solid. A recession isn't the main prediction right now. But the volatility, it feels less purely economic and more policy-driven. It's about political risk. Those tariff threats, if they stick, act like a tax on consumers, right? And the Fed pressure makes rates unpredictable. So understanding political moves is almost as important as crunching the economic numbers these days.
So wrapping up this deep dive, it feels like the market's positive run is definitely facing some serious hurdles.
Absolutely. The main takeaway for you, I'd say, is stay alert. Don't get complacent just because indices are high. Keep that diversified portfolio, think long term. But understand that these short-term headlines, tariff talk, Fed comments, the debt news, they can cause sharp sudden swings. But remember that volatility, well, it can also spell opportunity for investors who are disciplined and prepared.
What opportunities might emerge if you are prepared for these shifts in what seems like an increasingly complex landscape? Something to keep thinking about as you navigate the markets.
Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, We deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.